Options are probably becoming one of the most, if not the most popular asset for people to trade because of the numerous benefits that are part of it.
So, Al, as we continue talking about leverage, I kicked the show off about how stocks they're soaring right now, which is making them very expensive. Now, a lot of people like to invest in stocks in their retirement accounts, 401ks, IRAs, whatever that may be, any qualified retirement plan. Now, the stats are that the average person doesn't have enough to retire. And partially, I believe, is because they're not using the proper asset to invest with in retirement, because stocks only give you so much of a return. Now, when you use leverage with the options market, that could potentially give you more choices. Why would somebody want to gravitate towards the options market? And talk about some of the leverage that comes along with that.
Yeah, options are probably becoming one of the most, if not the most popular asset for people to trade because of the numerous benefits that are part of it. And one of the reasons that they're called options is because there are so many options with it. You can use very simple strategies to participate in up moving markets, down moving markets. If you have a portfolio, let's say you have a stock portfolio, and you're kind of buying into that buy and hold strategy, a long-term strategy. And by the way, everybody should have a long-term portfolio, something that you're going to rely on when you retire. But that's not something that you put together at one point in your life and then you just kind of forget about it and let it ride and don't participate in protecting what you have and maybe in trying to increase the returns that you have. Options will allow you to do both of those. Options can be used as protection because the most important thing for you is how much you keep. It's not how much you make, it's how much you keep. And we hear all the time people come in and say, I had these great trades I made, I was up like 400 or 500%, but then they ended up holding on to it, not protecting what they had, and end up probably losing or maybe even just breaking even on a trade. Well, you don't want that to happen with your full portfolio. That should be protected. You have insurance on everything else that's important. You have insurance on your home. You have insurance on your car. And you don't know for sure that your house is going to burn down. You don't know for sure you're going to have an accident with your car. But do you know for sure that your portfolio at some point in time is going to go down in value? That pretty much is a guarantee because the markets function that way. They go through corrections. They go through bear markets, crashes. And most of you are told just to hold on through those drawdowns and you'll be just fine. But remember this, if you have a portfolio that goes down any amount, the return has to be greater to get back to where you were. If you're down 50%, you have to be up 100% to get back to where you were. So protection is important. You can do that with options. It can function very similar to an insurance policy that you have on a car or a home. You can have an insurance policy on your portfolio. You can use options to boost the returns of your portfolio. If you have a stock portfolio, for example, options can help boost the returns. If you don't even have a portfolio, if you don't own any stock, you can actually have an options portfolio that mimics a stock portfolio. So you don't have to actually own a portfolio to do that. Options can be used in up markets, down markets, and sideways markets. Sideways markets are basically where the market has kind of gone to sleep for a while. That doesn't mean that there's no movement there. It doesn't mean that there aren't opportunities available. There are option strategies that allow you to do that. It's a very reliable strategy that a lot of the pros use to bring cash into their accounts on a pretty regular basis.
So what are some of the components? When you buy or sell a stock, you buy and you sell.
Right.
What are the components or some of the terminology of options so our listeners understand what they may have heard before, but they don't know what they are?
And that's one of the problems is that they've heard all these crazy terms and they have no idea what they are. What is a butterfly? What's an iron condor? What's a broken wing butterfly? What's a ratio spread, debit spread, credit spreads? Those are all just components of two things. There are only two options. There is a call option and there's a put option. Everything else is a combination of those. Those are all part of what's taught in education classes, but you always want to start with something very simple, very basic. And the very basic way to use options is if you think something is going to go up, you can buy a call option on it. And call options will go up in value as the underlying goes up in value. You can buy, if you think the market or an asset's going to go down, you can have a put position. A put goes up in value as the underlying goes down. And there's a lot of people that just trade that very simple way with those two options. And again, like I said, everything else is a combination of options. And the reason that they're all available is that there are different situations that arise in the markets, and there are different expectations and different goals that people have. And there's never going to be, or probably never will be, one strategy that is perfect for everybody, because everybody's a little bit different. And by the way, that should be part of a plan that you have that includes the proper assets and the strategies to use that asset for you. But the most important part of that plan should be controlling your emotions, so you don't let your emotions dictate what you're doing. You talked about the market being very highly valued now. That we kind of go into a euphoric phase where the people that haven't been in the market don't want to miss out on it anymore. That's that FOMO, fear of missing out. Always we find at the peak of markets, just before they roll over, that's when the public starts to invest the most. And it's those emotions, that greed emotion that takes over. Mm-hmm. When does the public usually leave the market the most? Right at the bottom, right when the values are there, when they should be looking at investing and buying. But if you just hold on, then you might not have the money available when the market turns to go back up again. That's all part of a plan that you should be following, where you can participate in an up market, protect what you make, and then have the ability to participate when the market goes down.
That goes back to the same thing with the futures and the Forex market. It brings more versatility to your investment plan. And, Al's talking about these different combinations: Iron Condor, Covered Call, Bull Put Spread, Cookie Monster. I actually just made that one up.
I know you did.
But don't worry about the terminology. All it is terminology. And you just understand what it actually does for you. So there's a lot of people listening right now that want to invest with options in their retirement accounts, but they may have a company-sponsored, like a 401k plan, and there might be some limitations to what they can do.
Sure.
Well, the great thing, if people have IRAs, technically, that is your capital, right? What can somebody do if they have an IRA with whoever it may be? There's many, brokers out there, whoever it may be. How can somebody take that over and do that?
Well, first of all, understand how to better manage what you have in your employer-sponsored retirement plan. You can trade within those. You just have limitations as to what you can trade. But one of the things that we talk about and help our students with is what we call dynamic 401k management. How can you get better results? How can you have better protection within those accounts? And there's some real limitations there. That's why a lot of our students want to get control of their own assets by setting up a self-directed IRA. As Josh mentioned, the money in your 401k is your money. If you leave a company for any reason, that money is yours to take and do with what you want. You can roll it into a new company's 401k plan, but why would you do that? Why would you take that money, put it into something that has limitations as to what you can invest in and has high fees, when you could have set up a self-directed account, roll the 401k money into that self-directed account? You eliminate fees. You have choices that you don't have in employer-sponsored plans. You can trade options in an IRA. You can trade the Forex market, the futures market. Those are great things, but one of the biggest advantages to you is you eliminate fees. Let me ask you this. If you put all of your investment money, your retirement money, on your dining room table, would it bother you if somebody came in and just grabbed $10,000 of it and left, or maybe $60,000 and left, and they did that every year? Obviously, that would bother you. That can be the impact of fees. If you have a $500,000 retirement account and you're only paying 2% in fees, and my guess is that you probably are paying more than that, but if at 2%, that's $10,000 a year that is being taken out of your retirement account. You're sucked away from you. It's no longer compounding for you. If you have a $3 million account, $60,000 at 2% is gone every year. You reach a point where actually the fees that you are paying exceed the contributions that you can make. So the number one way to increase your rate of return and to possibly have much better returns in your accounts is to eliminate fees. You do that with a self-directed IRA.
That is crazy. That's a lot of capital to take out as a fee to do nothing. Because think about this. They are selling you a fund, typically a mutual fund, and they are just holding it. Okay, can you buy a stock and just hold it? Of course you can.
Sure.
But most people are conditioned that they feel they need somebody to do it. I mean, if you have a $500,000 account and 2%, that's a huge fee, but people think only 2% is not that much.
Yeah.
That's why it's so important to be the best steward of your own money, because who's going to do that? That's going to be you.
It's interesting that you're conditioned to believe that you should pay that 2% for advice, but then you're not getting the advice.
Yeah.
But you're still paying the fees.
And the funny thing, too, is they say, oh, I just thought they're a good guy, but... Al, coming up on the last segment, I want to continue this discussion about retirement plans and kind of get a little deeper into the fees so people understand that they're losing a lot of capital because of fees. But also, a lot of people have that FOMO right now, want to get into the stock market, but don't have a plan. So I want to talk about how to set up a plan, rules within that, so they can do that with comfort. We'll be right back.